Hello everyone. Today I'm going to share something incredibly important with you. If you're thinking about becoming a shareholder in a company, because that's exactly what buying stocks means, just looking at the price isn't enough. The real questions are, does this company have a future? Is it financially healthy? What's its competitive advantage? In today's video, you'll learn how to analyze a stock in 5 essential steps. Not like a finance professor, but in a way you'll completely understand. If you're ready, let's get started. Asterisk first. Step. What does this company actually do? Let's look at Apple, for example. Most people say it's a phone company. But here's the truth. Apple doesn't just make money from hardware anymore. They earn billions from services too. App Store, iCloud, Apple Music. Another great example is Amazon. Started as an online bookstore. Now they make more money from cloud services than retail. Or look at Netflix. They went from mailing DVDs to streaming, then to creating original content. Having a diversified business model is crucial for risk management. Now let's examine the industry. Is this sector growing? Being in growing sectors like artificial intelligence or renewable energy is an advantage. Tesla benefited from the electric vehicle trend while Zoom exploded during the remote work boom. What's the competition like? Can anyone easily enter this industry? Industries with high barriers to entry, like pharmaceuticals that require patents, can be safer investment areas. Think about it. You can't just start making heart medication in your garage, but anyone can create a new app. Remember, a good investment is made not just in the company, but in its entire sector. Asterisk. Now we're getting to the technical part. But don't worry, I'll explain everything with simple examples. Income statement analysis. Have sales been growing over the last 5 years? We want to see steady growth. Is net profit positive? Is it consistent? Key ratios, PE ratio, price divided by earnings per share. For example, if a stock is $100 and earnings per share is $10, then PE equals 10. If it's too high, the stock might be expensive. Compare it with the sector average. Think of it like buying a house. You wouldn't pay mansion prices for a small apartment. Similarly, Microsoft might have a PE of 20, while a struggling retailer might have a PE of 5. But Microsoft could still be the better investment. EPS. How much net profit falls to each share? If we see year-over-year growth, that's positive debt and liquidity. What's the debt-to-equity ratio? Can the company pay its debts? It's a very important point. A company can be profitable but still fail due to its debts. That's why balance sheet analysis is vital. Think of it this way. Would you lend money to someone who already owes everyone? The same logic applies to companies. Lehman Brothers was profitable until debt crushed them. The work looked promising until their massive cash burn became unsustainable. Asterisk. One of Warren Buffett's favorite concepts, economic moat. How deep is the moat around the company? How difficult is it for competitors to cross? Types of competitive advantages. First, brand value. Coca-Cola, Apple. People pay more for the brand. They'll choose Coca-Cola over a generic cola, even if it costs more. Nike shoes cost more than generic sneakers, but people still buy them. Second, patents. Pfizer, Moderna. For years, nobody can make the same product. They have legal protection. It's like having the only key to a treasure chest. Third, network effects. Visa, Google, Facebook. The more users, the more valuable it becomes. Facebook is valuable because everyone is already there. Imagine trying to compete with WhatsApp when everyone you know is already using it. Fourth, cost advantage. Walmart. Nobody can sell cheaper than them. They mastered efficiency and scale. Costco does the same thing, buying in massive quantities to offer lower prices. Ask yourself, can someone else easily copy what this company offers? If the answer is yes, that stock might be risky. You want companies that are hard to replicate. Asterisk. The people running companies are also very important. After all, you're entrusting your money to them. CEO and management team. What's the CEO's background? Do they have a success story? Do they have a long-term vision? Or are they just focused on quarterly profits? Look for leaders who think beyond the next quarter. Visionary leaders take companies to different dimensions. Jeff Bezos focused on long-term growth at Amazon, often sacrificing short-term profits. Elon Musk pushes Tesla toward ambitious goals, even when they seem impossible. Transparency and reliability. Are there any past scandals, lawsuits, or penalties? How are shareholder relations? Are they transparent in their communications? Do they explain their decisions clearly? Do they admit mistakes? These are signs of trustworthy management. Very important point. A good company can fail with bad management. So you're investing in management too, not just numbers. Great management can turn around struggling companies, while poor management can destroy profitable ones. Look at what happened to BlackBerry. They had a great product, but failed to adapt. Meanwhile, Satya Nadella transformed Microsoft from a declining giant into a cloud powerhouse. Final step, and perhaps the most important, is this stock cheap or expensive? Here's a crucial insight. Low price doesn't always mean cheap. A $5 stock can be more expensive than a $500 stock. GameStop was trading at $300 during the meme stock craze, while Google was trading at $2,000. Guess which one was actually cheaper? PEG ratio. You divide the PE ratio by the growth rate. If it's less than 1, it's generally cheap. If it's more than 1, it might be expensive. This gives you a better picture than just PE alone. Professional valuation. There are DCF models and complex formulas, but they're too complicated for most individual investors. For beginners, PEG ratio is sufficient to start with. Warren Buffett's famous quote, "Price is what you pay, value is what you get." You want to pay a reasonable price for great value. The real question, is this company's future value more than today's price? If you believe the company will be worth significantly more in 5 to 10 years, current price might be justified. Asterisk. Now, let's see the most common mistakes that cost investors. Money. Common mistakes. Only looking at stock price. This is like judging a house only by its price without seeing the neighborhood, condition, or size. $1 million house in Manhattan might be a studio, while the same price gets you a mansion in rural areas. Blindly investing in stocks recommended on social media. Would you buy a car because someone on Twitter said it's good? Remember the GameStop and AMC frenzies? Many people lost money following the crowd, never examining financial reports. This is like hiring someone without checking their resume. Wouldn't do that? So why invest without research? Buying too many stocks and over-diversifying. You end up owning a little bit of everything and knowing nothing about anything. It's like trying to master 10 different skills versus becoming excellent. At 3. Right approach. Analyze fewer but stronger companies. It's better to know 10 companies very well than 50 companies poorly. Be disciplined, target the long term. Stock market rewards patience, not day trading. Research, learn, then invest. Never invest in something you don't understand. Practical advice. Start with 15 to 20 stocks from 5 to 10 different sectors. Analyze all of them with this method. This gives you diversification without complication. Remember, the stock market rewards the patient investor. Time in the end, market beats timing the market. Asterisk. Now you know how to analyze stocks like a professional investor. You understand not just the stock price, but the entire company behind it. Let's recap these 5 essential steps. You learn to understand the business, model, and industry position. You discovered how to check financial health with key ratios. You explored competitive advantages that protect companies. You examined the importance of quality management. And finally, you've learned basic valuation techniques. These tools will help you make informed investment decisions instead of gambling. With your money, if this content helped you become a better investor, don't forget to like this video. It really helps the channel grow. Subscribe and ring the notification bell so you don't miss our weekly investment tutorials. Most importantly, write in the comments, what company would you like us to analyze together using these 5 steps? I read every comment and your suggestions. Help me create content that actually helps you. Remember, investing is a marathon, not a sprint. Stay patient, keep learning, and let compound interest work its magic. See you in the next video, and happy investing.